Well, good afternoon, everybody. I trust everyone's grabbed some lunch now. The food is going to remain out. So as we begin this session, if you want to grab seconds or thirds, just use discretion and help yourselves. As well, in the front of the room over there to my left is sort of coffee and tea. So again, just in the urgency of time, we're going to begin the session, but if you do want to help yourselves to a cup of coffee or some dainties and treats, please go ahead and do so. My name is Zach Hanuk. I am the Director of Marketing Communications for the Jewish Foundation of Manitoba. And it's my absolute pleasure today on behalf of all of the staff as well as the board of directors to welcome you all to our first ever luncheon, which is part of our newly branded, what we're calling our Allied Professionals Series. So thank you for taking time out of your busy days to come out and learn from some of these professionals that you're going to hear from in a couple of seconds. Before I do introduce the panelists to my left and our moderator to my right here, I do want to give a special shout out to a couple of my fellow colleagues that are in the room today. The first person I want to introduce you to is Laurel Logan. Laurel, where are you? Laurel's right there. So Laurel is our Donor Development Associate. She works extensively with our current and prospective donors, with stewardship, ongoing development, and she is the first point of contact at our office for any donor to get involved. Okay? And the second person I want to introduce you to today, I'm sure many of you know him already, is our Chief Financial Officer, Mr. Ian Barnes, CPA, CGA in front of the room. So Ian, he wears multiple hats within our foundation, but he works also very closely with our Audit and Finance Committee, our Investment Committee, and he's also been a champion within our office for developing innovative programs and initiatives that continue to entice our donors to work with us, to work with the JFM in this ever-changing landscape. So Ian's here today as well. Now, what I want to do is I want to introduce the panelists to the left of me and our moderator, and we'll get going. So to begin with, I want to introduce Leilani over here, Leilani Kagan. Leilani practices as a member of the Tax and Estate Planning Group at Thompson Dorff and Sweben, LLP, focusing primarily on the areas of owner management taxation issues, corporation, reorganizations, trusts, and estate planning, and charities and nonprofits. Secondly, to my left, we have Ryan Palmer, CPA, CA. Ryan is a tax senior manager with KPMG Winnipeg, with more than 10 years experience in providing tax planning, compliance, advisory, and reorganization services to public and private corporations, trusts, partnerships, and not-for-profit and charitable organizations. Ryan brings significant experience in managing complex aspects of tax compliance and tax planning issues to his wide range of clients in many industries and sectors. And finally, moderating our session today is Mr. Dwayne Osborne, CPA, CGA. Cardinal Capital Management's Vice President and Chief Compliance Officer and in-house expert on charitable and planned giving. Dwayne is one of Canada's leading authorities on planned giving. This makes him a valuable asset to the firm when it comes to advising clients who want to create meaningful financial goals that affect positive change in the lives of those around them. So what I'm going to do is I'm going to step down, Dwayne, I'm going to turn things over to you and enjoy your session. Thank you, guys.
Since we don't have the 3 hours necessary to do this session in detail, we're going to get you out of here at about 12:55 with some more closing remarks. We plan to give you a bit of an overview on some things that are very topical in the world of charitable gifting today. As I travel the country speaking to both advisors and charities, some are not aware of these age-old techniques that are now creating new opportunities for fantastic philanthropy. So I have some people here that I've worked with quite a bit, and we've prepared to talk about 3 general topics. You are allowed to ask questions as long as they're not too difficult, and I will moderate you. I won't cut you off because we're getting out of here at 12:55, so you can get back to your busy days. But again, if you have a question, just let me know, and we'll have to have a discussion here. Again, we're going to provide overview comments, and there's materials in your binder there that are designed to catch you up. So in case you're not familiar with the GRE rules, we're not going to have a lot of detail on that. You're going to talk about application of them. So again, review those and contact us if you have any further follow-on questions. So the first thing we're going to talk about is the whole world of preferred shares, so privately held shares and their potential for gifting. So I'm going to ask Ryan to kick off the conversation on preferred shares.
Sure. Can everyone hear me? All right?
Yep.
Perfect. So preferred shares are, if some of you aren't familiar with the structure of a corporation, a preferred share is typically a share of a corporation that has a value that's fixed. So that fixed value preferred share provides ongoing value that's predictable in terms of what can be realized upon sale. We see quite often the donation of preferred shares being a really well optimized solution for a lot of business owners in the context of estate planning, minimizing tax liability on debt, and as well as actually fulfilling a charitable purpose. So in the context of a preferred share, there were we consider two situations. So the first situation with a preferred share is the individual holds that share and eventually gets it redeemed over time. So that redemption of the share is the buyback by the corporation, which causes a deemed dividend to the individual. So that deemed dividend in Manitoba can be taxed anywhere between 38 and 47%. Not a great result in the context of other available rates that might be lower. With that redemption, the individual gets the cash, has to pay tax on that cash, and then can make the donation of the after-tax funds. So the capability and capacity to make a donation is reduced because of the tax rate. If we consider the alternative to having the shares redeemed, we could look to donate those shares. So by virtue of a donation of shares, a charity would receive the preferred shares that the individual held prior to the donation. And the individual would be deemed to dispose of those shares at development. And with that disposition comes a bit of a better tax consequence. Where shares are disposed, we have a capital gain. A capital gain in Manitoba is about 25% tax. So the spread on that could be anywhere between 13 and 20% in terms of the tax that the individual would pay on fulfilling that charitable mandate. So with the donation of those shares comes a whole other cornucopia of issues. If we fast forward a little bit and say, oh, we've got these preferred shares that have now been donated to a charity. We have a charity that owns preferred shares that are worth something, but the charity has received no cash. So how do we rectify that? This is where that redemption concept that I mentioned comes into play. So where the corporation redeems the shares to the charity receives a dividend. That dividend is not taxed because the charity is a tax-exempt entity. And then the corporation can fund the payment out by virtue of that redemption to the charity itself. So again, if we pause and reflect on what's happened so far, the individual has preferred shares that they've donated. They've received a donation tax credit or donation receipt, equal to the fair value of those preferred shares that have been gifted. And now the charity, being a tax-exempt entity, owns these preferred shares. So we see now that the charity is a direct recipient or a direct conduit of being able to receive the cash from the corporation. And as the corporation redeems those shares, the charity receives the cash, no tax is paid, and the shares eventually get redeemed to nil. So in addition to the lovely receipt of money by a charity, there are other issues that a corporation has to consider. So if we look to redeem those shares over time, what's the first thing that might come into play when we think about cash flow? Does the corporation have the ability to fund that redemption overall? So cash flow planning, and I've provided two articles that are sort of quite useful in outlining some of the summaries, personal tax planning, donation of private company shares. This was written by two very smart people at KPMG and two very smart people at Deloitte. So this article, which summarizes what I've discussed so far and outlines some of the planning opportunities and pitfalls around donating preferred shares. So if we go back to the cash flow implications, we have to think about how that can be funded. Now this is typically through an agreement with the donor and the recipient charity to outline the terms upon which the shares will be redeemed, whether it's an immediate redemption for the entirety of the preferred shares, or whether it's a gradual redemption over time, say 5 to 10 years, to correspond with the corporation's cash flow that's able to fill that redemption. So in addition to that redemption and that planning around cash flow, it's important for the corporation and the charity to establish a unanimous shareholders agreement. It of course considers the rights of the charity as now a preferred shareholder of the corporation, and the rights of the corporation and its obligations to its shareholders in respect of this underlying agreement. So in my recent experience with the donation of private company shares, the unanimous shareholders agreement, from a practical perspective, isn't often done because it is significant in terms of work to develop the agreement. But where the value of the preferred shares is significant, and where there could be some cash flow concerns, that's where the unanimous shareholders agreement would come in and be quite beneficial in outlining the terms of redemption and any dividends to be paid on these preferred shares. As finance people related or involved with charities, you might have heard this term, disbursement quota. So this disbursement quota ties into the whole valuation concern about a share. If we have a share that's owned by a charity, that's considered to be an asset not used in charitable purposes. So we have to disperse something to compensate for that bad asset that we have. And again, going back to the unanimous shareholders agreement, that really ties into to drive some of these considerations and really ensure that we've got a fulsome donation that satisfies both the charity and the donor and kind of works in collaboration with the corporation and its expected cash flow.
Yes. Please bring this topic up. I was speaking to a small foundation in Ontario, meeting with their board, having a chat. I just mentioned not quite as well as Ryan just did it, but I just discussed it. And the eyes of the director lit up because we're right in the middle of this transition now. You mean I can give this first and save this much extra? And I said, yes, you can, right? So I had no idea. He's a financial planner, comes from the financial community, right? So don't, as Ryan said earlier, charities, those in the room, get the advisors in there early so that they can catch these kind of things in advance. And also, Ryan, I think I heard you say it was 15. Is it doesn't work if it's a third party sale? It's not the same benefit because of the dividend. Right, so we're trying to create a game, which you guys do every day in your business. But Lonnie, you mentioned agreements. Can you talk a bit more to the agreements requirements?
Sure, I'll do that in 1 minute, but I just wanted to go back to something that Ryan started with. And one of the things we're seeing here when we're working with the clients, and then when we work with some of you as well as clients trying to get the donors to understand this concept of donating shares. One of the things he mentioned is that it's a way to minimize tax on debt. And so I wonder if you could just comment on that quickly, because what we're trying to do is help you find ways to make this more attractive to your donors.
So in two situations of death, let's say you pass away owning shares of a corporation. So on your passing, you're deemed to dispose of those shares at the fair market value immediately before you passed away. So that would create a capital gain. And this goes into a deep, dark rabbit hole around pipeline planning and post-mortem estate planning that's a little bit beyond the scope of our discussion today. So ultimately, to the extent that a corporation can't get a beneficial tax result with the individual on passing, we revert to a dividend. So that dividend, as I mentioned, can be 38% in the case of an eligible dividend or up to 46% in a non-eligible dividend. But where we can deal with these things prior to death and access a capital gains rate, then we have a permanent and real tax savings around those particular preferred shares.
On that. So we've been talking about preferred shares and documentation. One important thing to think about when you're contemplating this with a donor is that you really want the donation of preferred shares. And it's important that they're preferred shares or preference shares. The reality is they need to be a fixed value share. You do not want to be dealing with the donation of common shares. I mean, of course, if you haven't been able to speak to the donor in advance and you receive common shares, there's a way that we can work with them within your structure and your organization. But the idea is that you want a fixed value share, and that's for two reasons. But the main one is that you want to make sure you're able to issue a receipt to the donor for the value of the shares. And if you receive common shares, you'll need to either obtain a valuation or have one obtained by the client, and you may not necessarily feel comfortable with the valuation that they've provided you with, so then you should seek your own. But that's the first reason. The second is if you're receiving common shares and there's no agreement around how those shares are cashed in, and there's no automatic right of redemption, which normally there is not with common shares, you may be the owner of these shares for a very long period. So you want to receive fixed value preferred shares that have rights of redemption or retraction. Now, in addition to that, you should look to make sure that the documentation around these shares shows that you also have with the shares a priority on dissolution of the company. And the reason for that is if something goes south with the corporation that you're now a shareholder of, you'd like to make sure that your shares are paid out first before other common shareholders or for the owners of classes of other preference shares. So you want to look at the documentation around the share rights when those shares are donated. So typically shares are donated pursuant to a deed of gift. It doesn't have to be a long, complex document. We work with several organizations that have come up with a form or a template of deed of gift that is easy for you to understand, it's easy for you to work with and to manipulate based on the information that is particular to each donor. But that deed of gift should describe the shares precisely, the number of shares and the class of shares. And I know this sounds simple, but make sure you've got the correct company. A lot of donors don't always know which corporation they're donating from, so make sure you have the correct corporation, the correct share class, the correct share number. Make sure that deed of gift uses the word irrevocable. This is like a donation of cash in your mind. This is an irrevocable gift. Once you receive those shares, there's no way for them to receive them back other than to redeem them for cash. So it's an irrevocable transfer of shares. You also would expect in this deed of gift, there would be legal representations about the donor's ability to donate the shares, the fact that they are the owner of the shares. There would be a representation in there that nobody else has a right or option to purchase those shares or own those shares, and that the shares are free and clear of any liens or encumbrances. And that's important because if the donor has provided security for a loan by way of a general security agreement, or with hope not, but sometimes a pledge of those shares, they actually cannot donate them to you. So you would go through this entire exercise and only then be served with a notice by a lender, a bank, another individual, saying that they have a lien on those shares. So you want to make sure that the donor is able to donate those shares free and clear of any liens or encumbrances. You want to make sure in the deed of gift there's a statement that the donation has been duly authorized by the corporation. The shareholders making the donation, invariably the board of directors will have to approve the transfer of the shares. So you want to make sure that that is duly authorized by the board. If there's an existing shareholders agreement in place that deals with those shares, you'll need to review that shareholders agreement to make sure that A, the shares can be transferred to you, and B, that no waivers have to be signed or consents have to be filed or signed by other shareholders in regard to the transfer of those shares to you. So that would be the deed of gift itself. And pursuant to the deed of gift, there would be stock transfers that would be delivered to you with the actual share certificate. And you having the actual share certificate is one way to ensure that a lender doesn't have it, for example. So you want to see the actual share certificate along with the transfer documentation. And then in the agreement, you'll also want either a side agreement or in the deed of gift itself, or as Ryan spoke about, if there's a shareholders agreement that would now include you, you want to clearly delineate the terms under which you will redeem these shares, because that is your cash. Now, ideally, you'll want to redeem these shares immediately in terms of like 2-day turnaround. You'll want to cash them in. But as Ryan mentioned, if the corporation doesn't have the cash to pay for those shares, you're going to have to negotiate a payout schedule. And that is something that should be signed in writing at the time you take the shares. Otherwise, you may find yourself holding onto those shares for much longer than you would expect. And the other type of documentation that would come into play here is, of course, the receipts. That's what the client will be asking for. And then we get back to the valuation, and that is very simple for you if they're fixed value preference shares. So you can ascertain the value quickly. If they're not, and if let's say the client doesn't have fixed value preference shares, so they say, I don't have these, we can always create them. There's a way on a tax-free basis to the donor, we can create fixed value preference shares in the amount they wish to donate to you. So that is something that we can work through and achieve for them. And then what you will want in this as well is a clause or an agreement that indicates that this gift of these shares is going to be binding on the donor and their estate. often these things are negotiated as sort of end-of-life transactions, and you want to make sure that there's nothing that can impede this donation coming through successfully and the potential for redemption of the shares being stopped or blocked by anyone. So you need to make sure that this deed of gift and the agreement around the share redemption is binding on the donor's estate and their family.
Thank you, Lonnie. Just another word of caution, since Lonnie was sort of laying out there. This whole idea does not work well with private foundations. Okay, it doesn't work well at all. In fact, it can actually not work at all. So, if the clients want to do it to their own foundation, that you want to rethink that and read just 80 pages on excess corporate holdings because there's clawbacks and obligations to spend. But the Jewish Foundation of Manitoba, JFM is in business for this kind of thing. Public foundations and charities are wide open as our strategy. So. That's the only other caveat I would toss in there. So, great. Any quick questions on that? Everybody? Yes?
So then you talk about the fixed value for shares. Is CRA ever look at focusing on this? And value you consider arbitrary?
It depends on how the value was arrived. So if these were fixed value shares that were created pursuant to, let's say, an estate freeze or a corporate freeze years before, then CRA could potentially ask you when you issued the receipt, how did you come up with that value? You would say, the documents in the corporation show me that these shares are redeemable for $1 each, and I have 100,000 of them. They then would go the next step and say, how do you know that they're $1 each, and why are there 100,000 of them? If they arose from that prior transaction, they could look at that, and then what you're hoping is that the advisors, the lawyers and accountants for the client that completed the transaction years before, used an independent or third-party method to value those shares at the time.
In the absence of using a freeze, stock dividend also works well to carve out that value without evaluation. So again, depending on how the shares came to be, you may or may not have a value, but the share rights in the articles should provide sufficient color in terms of are they redeemable or trackable at $1 or some other metric.
One other thing I wanted to mention, and that is if the shares are not redeemable immediately, so if there's not cash available for you to realize all those shares immediately, and you are then working out an agreement about redeeming over time, as the recipient organization for those shares, you're going to want to see financial statements. You're a shareholder. You're entitled to every right as a shareholder. You may be entitled to vote depending on the share rights, but you'll want information, and you'll certainly want to see financial statements, and you'll want to see your fixed value preference shares in those statements.
One more question quickly?
Yeah. So I heard reference early on to the capital gain versus dividend, different types of dividend shares. But I somehow thought I heard you say that when we do these preferred shares, you're going to somehow convert dividends to maybe any present value of the dividends to derive a capital gain instead. Is that what you're doing?
So the actual result, of the donation of the preferred shares causes a capital gain to the donor. So it's a disposition of those shares for the donors.
But the fixed value was X, and there's transacting evidence. So there shouldn't be any capital gain in that case, unless you're doing a present value.
Well, no, it's a capital gain because you're disposing of the shares at the value of the preferred shares, and your cost base is presumably low.
I see.
So that difference is your capital gain subject to 25%, versus if you had the shares redeemed, then that would end up being a dividend at redemption on those shares.
That's it.
And then presume that capital gain is zero inclusion rate?
No, it's a full inclusion rate. The Liberals, when they came into power,
No. Be nice.
there were proposals to make a 0% inclusion rate on donation of private company shares and certain real estate. When the Liberals came in, they dismissed that. There's been sort of reinvigorated discussions on that concept about a 0% inclusion rate, with a view that it would potentially encourage charitable donations of private company securities, right, as it does for public securities with that same 0% inclusion rate.
Great, thank you. I want to move on to our next topic because speaking of legislation, there was a massive wave of legislation in 2014 called the Graduated Rate Estate. Maybe you may have heard of that. And then again in 2016, it's direct application of charitable gifting. In fact, we still could see deaths prior to 2015. The old rules kick in. So I've asked Alani to make some comments. I'll ask you with regard to what kind of issues can she see with regard to using graduated estate today with charities?
So the way a graduated rate estate would affect yourselves as charitable organizations is that when they brought in this concept of a GRE, alongside it, they brought in a concept of different rules regarding donations made by a GRE estate and a non-GRE estate. And I still can't figure out from a policy perspective why this applies to charitable donations, but it does. And so one of the things you'll want to look at is if you are receiving donations from an estate or you're speaking with someone who's making a planned gift within their will, you'll want to make sure you understand how that gift is being made. If it's being made through the GRE and the intent is that it should be made through the GRE, or whether or not they're restructuring it as a non-GRE gift, because the tax consequences to them are going to differ. One of the important things to note is if people are looking to make donations through their estate, that's the GRE donation, versus a testamentary trust that's created within their estate. So when someone dies, their estate comes into effect immediately, automatically by operation of law. When they're gone, their estate just takes their place. That is the only part that's eligible to be a GRE. If they set up a testamentary trust for their children, a spousal trust for their wife, a trust for their cottage, all of those trusts are testamentary trusts. They cannot be GREs. And so if they are going to make a donation to you, it has to come from the estate that arises on their death for the GRE rules to apply. And one of the reasons why you would like the donor, or the donor would like to donate through a GRE is, for example, the nil capital gains inclusion is available on the donation of publicly traded securities to charities like yourselves, only if it comes from a GRE. A donation of publicly traded securities from a non-GRE is not eligible for the nil capital gains inclusion. And so that's an important thing for your clients to know, or your donors to know, because of the fact that they're planning around having zero capital gains inclusion. And for that to suddenly change because they made the gift through a testamentary trust, like a spousal trust or a children's trust, that's a big tax effect given the numbers that we've been seeing with people wanting to donate these publicly traded securities. So there is a way for there to be a tax effective receiving and donation tax credit used through a testamentary trust. There is a way, it's a non-GRE trust, but the language has to be appropriately worded within that testamentary trust for the tax credit to be applied where the testator wants the tax credit to be
applied. Given these things, there's been prior planning in the past, can you see any issues with, say, tainting a GRE or causing issues later from prior planning they've done years ago?
One of the ways you can taint your GRE, well, there's several ways. There's a technical way. The easiest technical way to taint your GRE is to not elect for GRE status in the first tax return of the estate. So you want to make sure when you're speaking with representatives of your donor's estate that they have filed for GRE status. There is no way to make a late filed election, but you can file the whole tax return late. So if they haven't yet filed the first year's tax return, or no, it's not even the first year, it's the first tax return, so people don't file the first year. So the first tax filing has to elect for GRE status. That's the technical way to not get GRE status. The other way to taint it is, for example, to have non-arm's length parties to the estate make loans into the estate. And that can be as simple as people paying debts at the estate with their own credit card, banking accounts, and then saying, I'll be reimbursed once we get cash in the estate. You have to be really, really careful about that. So you want to see what's going on in the estate since the estate arose, i.e. the date of death, when you're looking at ensuring the client and donors making a GRE donation.
I'm sure finance is very aware of there's potential for compliance delays, litigation, so I'm sure they would honor a delay, or would they not honor a delay?
We've got people now asking about why. So a GRE can only last for 36 months after date of death. You can still make the donation up to 60 months after date of death, but the GRE itself only is allowed to use the marginal tax rates for 36 months. So we have people asking about drawing out the estate administration. Now, estate administration takes quite a while as it is, and so I tell clients, don't be too anxious to wind up almost everything and just leave a little bit in there to draw it out to pay tax at the lower rates, because that starts to look disingenuous from a CRA perspective. Otherwise, they may say, you need a legitimate reason to not wind up this estate and lose your GRE status. So legitimate reason might be beneficiaries who are swallowing assets that you're having a hard time liquidating, maybe some complex tax planning and tax filing that has to go on. So there's ways you can draw out the administration up to 36 months. I know from a recipient organization perspective, that is not music to your ears, because you would prefer the estate be wound up and you receive your donation sooner rather than later. But there is a move amongst people to try to draw out the administration so as to take advantage of the lower tax rates.
And not necessarily related to GRE, but if you could relate it to GRE, what about the charitable remainder trust? The whole concept of that, using that trust.
So the charitable remainder trusts are still alive and well. One planning technique that we've been speaking to donors and charities about ourselves is that there's, again, a question as to where the tax credit can fall if the charity is a beneficiary of the trust, or whether or not the trustees have the ability to make a donation to the charity through the trust. And so what we're doing is essentially we're drafting both. We're giving the trustees the right and the power and authority to make a donation to the charity in the trust document itself, so as to get the receipt in to offset terminal return taxes. But then as a fallback, because some people don't necessarily think their trustees are going to make the right choice, we then name the charity as a residual beneficiary if the gift is not made. And so it's kind of like a fallback to make sure the donor has confidence that you're going to receive the money.
Any quick questions on GRE or use of trusts? Move on to the next area. Again, yes, before 2016 are still using the old rules, deemed death, okay, date of death, tax receipts, that sort of thing. So you may still see one of those in that 60-month period I was mentioning. Ryan, I've noticed in March 21st, 2016, some changes happened in insurance.
Remember it like it was yesterday.
Like it was yesterday, and I went from seeing none of this to 5 this year, and that's actually a corporate gift of life insurance versus an individual gifting it. Can you comment on it?
Sure. So in general, with some background on insurance, we think all understand the concept of insurance very generally. In 2016, they introduced rules that changed the way the Income Tax Act deems proceeds of disposition when you dispose of a life insurance policy to actually be calculated. So in the context of called pre-2016 rules, the Income Tax Act in 148 provided that if you were to sell your insurance policy, the policy is deemed to be sold at value. At that time, value was defined as cash surrender value of the policy. So to the extent that that was the deemed proceeds of disposition, and if your cash surrender value was less than your adjusted cost base of your policy, there would be no policy gain. And in the context of an individual donation, you could donate the policy at the fair market value of the policy and only have a policy gain to the extent that your cash surrender value exceeded your ECB, which in some situations, some policies, that might not have been the case. From a corporate perspective, where a life insurance policy is held by a corporation, any premiums or any face value of policy in excess of that, of the ACV of that policy, before 2016 came into the corporation as a capital dividend. And so the capital dividend is a tax-free dividend that can be paid out to a shareholder. With the changes in 2016, a few really significant components of insurance were changed. So the calculation of the adjusted cost base of the insurance changed. The mortality tables used in computing the net cost of pure insurance changed, and the calculation of the capital dividend with respect to insurance in a corporation changed as well. If I can sidebar for a second and reflect on some planning that we've done in the past. Let's say we have an individual with an insurance policy of fair market value of $1 million, actuarially determined. The cash surrender value was nil, so it was just insignificant, and the ACV as well was nil. So to the extent that individual, this is again before 2016, transferred that policy to their corporation, they were deemed to dispose of that policy at cash surrender value, which is zero. And if ACV is also zero, there would be no income consequence to them when they donated the policy. As consideration for the policy, they received a shareholder loan from their corporation at $1 million. Great result. You get to get rid of this policy, transfer it to the corporation, take back $1 million, and at the time, there was no impact to the capital dividend account to account for this acceleration, so to speak, of the payment of the insurance. So fast forward a number of years, the individual dies, the capital dividend comes in, and it can be paid out. So this is exactly the kind of monkey business the CRA didn't like, but it was good for our clients. So with these changes, they've essentially eliminated the benefit with the capital dividend account. So to the extent someone passes away after having transferred a policy to their corporation, the tax-free premiums that can be paid out at tax-free value, I should say, that can be paid out as a capital dividend are reduced by the amount of value that you got back. So if you took back a shareholder loan, the capital dividend that you get to take out is reduced by that shareholder loan. With the calculation of the ACV, it changes quite significantly the curve along which the ACV changes. That's kind of a circular statement, but to the extent the ACV is higher longer, that means the capital dividend is lower for a longer period. So a little bit worse of a result for a corporation that owns a policy. Fast forwarding now to our 2019 planning, a lot of corporations, by virtue of having this planning been available to them prior to 2016, now have these insurance policies with value greater than their cost, or value greater than what the value was when it was first transferred in. So you say, well, I want to work with Dwayne and Cardinal, or I want to work with Jewish Foundation Manitoba, and figure out a way to get my charitable purpose, my charitable desires, so to speak, to be materialized. I want to donate this policy. So donating the policy, much like any other donation in a corporation, is subject to the 75% limitation. You're not able to donate something in excess of 75% of your net income, and anything in excess of that is carried forward. So we have this donation now, this policy that would be really good to transfer and get a charitable donation receipt from a charity. So transferring that policy causes a disposition for the corporation. Now, if the corporation disposes of that policy to a charity by virtue of donation, then the new section 148(7) in the Act says that the deemed proceeds of disposition are the greatest of three amounts: the cash surrender value, the ACV, the adjusted cost base, and the fair market value of the consideration received. So if our consideration received is zero, then our deemed proceeds could be zero. To the extent we have values that are different in the ACV cash surrender value, that's where this gets a little more complicated. Ultimately, the pros here are that you still get a donation receipt equal to the fair market value of the policy, which is important. But the downside is there is a bit more work around calculating what kind of income inclusion might be realized by a corporation if they were to donate a policy. Because of these changing rules around the ACV and the calculation of the net cost of pure insurance, it's a little more onerous than it once was.
What about if the shareholder is trying to sell the company and this policy is owned by the corporation? That might muddy the waters up a bit?
A little bit. So if a corporation owns an insurance policy, and let's say you're a small business and you want to avail yourself of the qualified small business corporation share definition, well, that insurance policy is not an active asset. So you've got a corporation now that has an inactive asset that might taint its ability to get tax-free treatment on sale. So the shareholder says, well, what do I do? I've got this policy here that is going to cause me a problem. I want to take it back. I want to take the policy back to my own personal name. So to the extent that we do that, there's a deemed disposition subject to 148, but then there's also under section 15 of the Act a provision that says that a shareholder who receives an asset from a corporation is deemed to have that amount as income. So in the context of a shareholder, it could be a deemed dividend, not at the low cash surrender value, or at the ACB, but it could be a deemed dividend at the fair market value of the policy actuarially determined. So all of a sudden you have something you think might not have caused any tax consequences, but now you have a deemed dividend personally for $1 million. Who's going to pay the tax on that? In the context of a non-QSBC situation, ignoring all of that tax planning, the result I don't think changes much. You still have the deemed dividend, and the corporation is deemed to dispose of that policy subject to 148.
Thanks.
So
Yes.
the deemed dividend, so it's donated by the charity. You're saying the deemed dividend comes to the individual?
So if the individual takes the policy back,
Well, it takes a bow, I see, but it's not the charity.
correct.
No, the whole idea is the better alternative in most scenarios as opposed to taking that.
I see, okay.
In the situations I discussed earlier, the individual went because again they were caught in this transaction and it's massive employment benefit coming to them, they didn't want to pay it. So they changed their will, but their plan there and put the insurance out through the corporation. So that way the charity still benefited. They just had to get this thing out. And it was a massive benefit. They were unaware totally, and they're in the industry. So we thought we'd put that out there. Charity is no different if you as a corporate gets insurance, you're going to issue a tax receipt for the fair market value, which also is as that deemed benefit back to the shareholder their buying commission. So again, legislation has created an opportunity for you to take advantage of some of these policies.
I can just jump in quickly with one other thing. So,
No, I'm sorry, I'm not moderator.
okay, fine. So as an alternative to taking the policy personally, there is planning that exists to use a sister corporation or even a parent corporation to move that policy out without having to deal with the personal tax as a deemed dividend. The downside of that, as Lonnie and I were talking before, is since 2015, the taxation of dividends between corporations has changed quite a bit. So normally you'd be able to move any amount of money up as a dividend through an inter-corporate basis, not have to worry about any funny tax consequences. But now you have this concept of safe income. It says that where you have a dividend paid from one corp to another, unless there is sufficient safe income to cover that, then you have this capital gain in the recipient, which again, not a tax-free transaction, but something to think about when you're advising and working with your clients and donors that, how do you have this policy owned? And what is your broad corporate structure? Do you have other corporations in the group that you might be able to utilize in order to defer or eliminate some of that tax on moving the policy around?
That was the best definition I've heard of planned giving ever presented. Okay, that's exactly the difference between major gifts and small gifts. You see now why they call it planned gifts. It heavily involves the advising community being actively engaged in the process. Quickly, both panelists, if you could comment just briefly, how can charities help engage advisors in this since they're so necessary to this process?
One of the key takeaways from your whole advisor series is that it's important to have advisors engaged early in the process. Everything we've talked about just now about ensuring you have the correct share class, ensuring that the insurance is being dealt with appropriately, all of that needs to be put in place before you get involved as the recipient of these types of donations. And so working with advisors early in the process is key. None of this can happen very quickly. Transferring insurance policies, I don't know if any of you have worked with any of your donors on that, it takes a bit of work to get that done. So you want the advisors to be involved early. To the extent that you have advisors already sort of in your pocket based on where you work and who you may have relationships with, I think we both encourage you to meet with them and sort of freshen up all of your policies, your documents, your procedures, and have them sort of at the ready. And also talk to them about how not every donation transaction is going to be the same. So you want to make sure you understand the documentation they're preparing for you, but also that you can call them and ask them on a one-off basis for advice on these types of transactions. If you don't have someone that within your professional bailiwick that you can rely on, maybe you should be asking the donors that if they have advisors to meet with them. This goes to that also making this donation a success. You need the donors' advisors on site because they're most likely going to be adding, as this article talks about, credibility to you and the process. If a donor can call their accountant or their lawyer or their financial planner and say, I met with Ian from the Jewish Foundation, and he was talking about this and oh, I heard about this, we do this all the time, let me call Ian. The donor is much more likely to feel confident about what they're doing, have some clarity around the whole process, and it's going to lead to a much higher rate of success with your donation.
Quick comments, Ryan?
I agree.
Okay.
Well, that concludes today's session. I want to say thank you to Dwayne, and to Leilani, and to Ryan for bringing some of your intellect and some of your insight into this very interesting topic. Before we wrap up, I just want to say it wouldn't be an event without a door prize of sorts. So underneath one of your cushions, there is an Amazon gift card just in time for the holidays. So take a look underneath your cushion. You could be walking away with a gift card. Okay, so have a quick look there. Second, I just want to say quickly why you guys are standing up awkwardly looking at the chair. There it is right there. Congratulations. Next May the 7th in 2020 is the Jewish Foundation of Manitoba Luncheon. We haven't officially started selling tickets, but in the programs you will see that we are bringing in, we're very excited to bring in Canadian journalist and commentator, pundit Rex Murphy. We're bringing him in. So he's going to be very interesting. He's going to be engaging. We're going to do a sort of interactive discussion with him where he's going to talk about kind of the state of the world, the state of Canada. It'll be very engaging. Corporate table sponsorships are available. We're expecting about 450 of not only our community, but the general community to come out to this thing, business leaders, community leaders, male and female. So it'll be great to see you all out there. Lastly, I'll say is we're going to send out an email tomorrow just to follow up to coming up today, and we want to know your experience, what you guys thought of today's session, but also we want to continue these sessions. So we want to hear from you about potential topics that maybe you would like us to address, or you'd be open to addressing, just like our panelists did here today. But on behalf of the foundation and our board of directors, thank you guys for coming up today. Thank you again to our panelists and to our moderator, Dwayne, and enjoy the rest of your week. Thank you.